All right. Well, thank you very much for having me here today. And let's let's get started. So bear with me 2 seconds here. Let me take a little sip here. Okay. So um, what we're going to talk about here today is one of my favorite topics in general on trading is options. So we're going to talk about using options for income and hedging and a five-step plan that you can witness here today and see if it will help you going forward in the future. So let's get started. Um, So we're going to look at step one, avoiding the number one option trading mistake. Two, the most important option factor. Three, how option pricing works. Uh, Four, knowing and using the market maker's secret. Five, highest probability option strategies for every market. Now, the following webinar is purely for educational purposes. Any stocks, ETFs, options mentioned does not constitute advice and should not be construed as a recommendation. Now, I've been actively trading. I appreciate the introduction for over 30 years and was executive vice president for one of the largest oil trading companies in the world, Trans World Oil, and ran the international trading desk there for over 10 years out of the beautiful island of Bermuda. So if you ever have a chance to visit Bermuda, take advantage of it. It's a beautiful place. I was very, very blessed to have been able to live there. But anyway, trading is such a great profession because I love it because it stimulates the mind. It's a great way to make money from any place you want to live. So, but it's a continuous journey of learning. And for me, this was a great training ground for me as far as learning a lot about the markets. We pretty much traded everything, and it's where I first got my introduction to options back in the early '80s, trading options on over-the-counter crude oil. So it kind of became my passion ever since then, just because of all the different things you can do with options. And then went on to launch the over-the-counter option brokerage desk for PVM Oil London. They're the largest privately owned oil brokerage company in the world. Again, another great learning experience for me for learning more about options there with institutional type traders and hedge funds. But basically trading again for yourself can be such a rewarding job, but it can also be very painful and stressful, as probably everybody here can attest to. So you really need to stay educated about what you are trading and stay very focused on managing your trading risk, and especially in volatile times, which we've had a lot of over the past couple of months. And for me, the real kind of aha trading moment actually came about when I started to incorporate selling options into my trading plan for profit and for hedging. And this is what I'll be talking about here today. So step one, though, is avoiding that number one option trading mistake. And, option trading has so many more advantages than trading stocks, but as you probably know, it's a bit complicated as well. And for the individual trader, options can be a little intimidating. That's why many investors will trade options by purchasing out-of-the-money options, often short-term options, since they will cost a lot less than the long-term option. It's a simple strategy as well. So for example, out-of-the-money calls or options in general are especially popular because they're cheap and seem to follow the old Warren Buffett paradigm that we've kind of all grown up with is, hey, let's buy low, sell high. But is this always the best option strategy? So imagine you're bullish on Facebook and it's trading at $100. Now, as a beginning option trader, you might be tempted to buy calls 30 days from expiration with a strike of 120 and at a cost of 15 cents, which would be $15 per option contract. And why would you do this? Well, because you could buy a lot of them. So let's do the math and let's show you what this would look like. So if you were to purchase 100 shares of Facebook at $100, that would cost you $10,000. But for that same $10,000, you could go out and buy 666 contracts of the 120 calls and control over 66,000 shares. Wow, that's pretty mind-boggling when you think about that kind of leverage. And then you think, okay, well, what if Facebook was to hit $121 within the next 30 days, and those 120 calls now are trading at $1.05, which is $105 per option contract just prior to expiration. You do the calculation on that, and you can see, well, you can make over $59,000 in 1 month. Now, at first glance, this kind of leverage is awesome. But you don't want to let this glitter fool you, because not losing money is just as important as making money in trading. So the one problem with short-term out-of-the-money calls is that you not only have to be right about the direction that the stock moves, but you also have to be right about the timing. And that's what really ratchets up the degree of difficulty. So to make a profit, the stock doesn't just need to go past the strike price, but it also has to do it within a defined period of time. Now, in the case of these 120 calls on Facebook, you need that stock to reach 120 within 30 days to make a profit. And it's this dual objective of having to be right about direction plus timing. It really lessens the probability of an option trade being a winning trade when you're just constantly buying options. And everything I teach my clients is that it's really based on managing your risk and increasing the probability of your winning trades. So in this Facebook option trade, you're wanting that stock to move more than 20% in less than a month. And this would be like a 2% or 2 standard deviation move. And really, how many stocks are likely to do that? Well, we'll see the occasional crazy movements from a Tesla or Netflix or something like that, but really, in all reality, not many. So in all probability, the stock would not reach that strike price and the options would expire completely worthless. So based on probability, and we can theoretically measure probability with options by using standard deviation, there's only about a 5% chance for the stock to reach 120 to 121 by its expiration. So in order to make money on out-of-the-money options or out-of-the-money calls in this example, either need to outwit the market or get plain lucky. And we used to always kid around the trading room that there was an old blues song, and one of the lines in the song was that I had no bad luck, I'd have no luck at all. Kind of summarizes how it usually goes for you. Now also, being close means no cigar. Imagine then Facebook was to hit 110 during that 30 days of your option lifetime. Well, you could be happy about that you were getting the direction right, but you were still wrong about how far it would go within a specific time frame, and you'd still lose up your entire investment. So this is always outright painful when you have continuous loss like that. Now, so it's based on kind of this trade example. A better goal for every trader, in my opinion, would be to select trades based on what provides you the most consistent positive return and not that one-time big winner. And consistency in your trading is derived from making high probability trades that are based on reliable data and facts. Now, where there's a big disadvantage, such as the one you saw in this option buying scenario, you can usually just flip the side of the coin and see an equal opposite advantage. So in case of being a seller of option, this gives you a huge advantage over being a buyer. And all the pros, professional money, they know this and they take advantage of this, and so can you. So as a seller, all the things in this example on Facebook are the same, but in your favor instead of against you. So this is why a lot of people will take advantage of selling options for income generation and profit and for hedging. Now, by selling an option, you're in essence selling time, and it's a really powerful kind of trading dynamic when you think about it. And it's a strategy that's yours for the taking. Now, you can think of an option as like a coupon you'd get at a store, and it must be redeemed by its expiration date, or else it's going to be no longer valid. But how is this done, and what's involved in this? Well, step 2 is the most important option factor for the income generation side of things, and that's understanding the concept of time. And it's pretty simple, as you just saw in that one example. Now, time value is used to trade strategies that take advantage of the accelerated time decay of the option into its expiration. And option income strategies are very tied to the time value and the impact that it has on the price of an option. So in options, the time value is also known as the extrinsic value of the option, and it's the premium that a rational investor would pay over its current exercise value, which is the intrinsic value based on its potential to increase before expiring. Now, this probability is always greater than 0, thus an option is always worth more than its current exercise value. So I want to show you a chart, and then so you can see how predictable and powerful this kind of option time paradigm is, and then I want you to answer this question. So here's a chart showing you time decay, and let me see if I can get this pen to work. Okay, good. So when you look at 120 to 90 days out, right here at this part of the chart, you'll see that the time decay is very, very small and gradual. So if you look on an option chain, you'll probably see, when you're 120 to 90 days out, you'll see -1 under time, and this is theta. You can measure your time decay by theta. And so that -1 means $1 per option contract. Now, as you get closer in and you get like 30 days out, right in here, you'll see this accelerate, and this will go, to $5, $10, and before you know it, you're at zero. So, you can kind of think of this as a current, a really strong current going out. And if you're constantly trying to buy against this current, it's going to push you back. So unless you get a really strong price momentum to the upside in case of buying calls, you're going to, end up losing money based on this accelerated time decay. So you really got to get it right if you're buying options all the time versus at some other points, maybe you should be looking at selling. So, it's the underlying security. So just think about that from that chart you saw. If the underlying security that you're looking at buying was to go sideways with no directional trend at all, would you have actually wanted to have bought those options 120 to 90 days out, or would you have rather sold those options? So just put in a yes or a no. Yes if you would rather sell the options way out, or no if you'd rather go and buy those. Exactly. So yes, you can pretty much see it. So this is the common natural time value progression for all options. And think about if you're wandering around in a mountain range blindfolded, sooner or later you're going to end up falling off the cliff if you're blindfolded. And that's how it is if you just constantly buy options. Now there's another great thing that if you get a chance, Google, there was a great interview done by Tasty Trade, and it's on YouTube. Just Google Karen the Super Trader. And it's an interview about this lady that Tasty Trade found out about, and she had started off, taking courses on options and constantly buying options and constantly losing money. So finally, the light switched on for her, and her aha trading moment was, hey, what if I took the other side of the trade and sold options? Well, she ended up doing that, and she ended up making a lot of money and became a huge trader. Now she manages hundreds of millions of dollars. So check it out, Tasty Trade and Karen the Super Trader. You really get it's amazing. So then step 3 though is, how does option pricing work? If you understand the concept of the pricing mechanism, then you can have a better idea how to use options. Now the main components to value an option is just time value times its implied volatility times its intrinsic extrinsic value. And once you know these variables, then you're ready to go out and price the option and know what option premiums you should look at, buying. Now here's another table to illustrate this. Let me get my pen. Now every Thursday you get a new weekly options series that comes out. So when that series hits the ground on Thursday, you'll have 100% time value in that option. So time value times the implied volatility times the intrinsic extrinsic value equals your price or your premium of the option. So on Thursday, you've got 100% time in that value times implied volatility, kept this at constant. That gives you a price of $300. Now, if you look down Monday, you can see the portion of time value there is cut in half. And it's only 50%. So 0.5 times, even if implied volatility spikes up, 800 times 1, it barely really pushes the price of your option premium up. And then as you can see, before you know it, you're at zero. So you really have to get that direction, exactly right if you're buying options. Now, step 4 then is the market maker secret. And this is what they don't want you to know about. This is where they can make easy money off the market. Now, if you think about broad markets, you'll see that they'll tend to have 2 to 3 week type cycles. And, they'll go up or they'll go down, and then all of a sudden you'll see them just kind of churning sideways in channels about 70 to 80% of the time. So it's based on this sideways price movement that the out of the money option buyers will then lose approximately 70% of the time. So the market makers, they know these statistics, and therefore they're going to tend to trade as much as they can from the sell side to take advantage of that kind of sideways action. And this is the professional money. So you want to be able to understand what they're doing and think like them, and then take advantage of it as well. And it's all based on the math. Now, the market makers, they use mathematical market probability statistics to price out the movement of an option to its expiration. And by knowing the probability of your underlying security finishing within a certain range, price range at expiration, is key when you're trying to determine what options to buy or sell and also what option strategy to implement. So if you understand this concept, then it becomes more clear to you what to do. So it's these statistics that forecast how likely it is that an option will fall within a certain price, either up or down by its expiration. And it's this statistical forecast, it's referred to as the implied move of the stock. And this implied move is an estimate of a plus or minus theoretical one standard deviation move of the underlying security itself. So that's a lot of words and stuff right there, but I'll just kind of show you some clear examples of how this works. So now we can all take advantage of the same information since we have option platforms ourselves. Everybody here has access to one, and a lot of them are free. So it's based on these probability statistics that if you're looking to sell options or option spreads, when you use those correctly, this is going to provide you the highest probability trade setups for generating consistent profits, and it's also a great way for hedging. Now, options were originally developed as a risk management tool to hedge your positions, but they've gotten so big now that there's a lot of money to be made just from the speculative side. But it all comes down to the math of probabilities. So if you look at this is if you take the statistics, you'll notice this is a normal distribution curve, a bell curve for looking at distribution of data. And in this example, it's price. So when you have an option platform, it's going to give you all this information. So this is Google, and it'll tell you on this example, the implied move will be given to you plus or minus 4%. Your days to expiration will be given to you 10 days in this example, and then at the money price. So it's $500. So this is at the top of the curve right here. And this is where all option pricing starts. It's at the money. So all the supply demands here. So first this price is determined, and then the other prices out of the money calls, out of the money puts, then those are determined off of that at the money price. That's called your option skew. Now in this example, if the move they're calling for theoretically is plus or minus 4, so that's 4% down from 500, that'd be 480, 4% up from 500, that gives you 520. So it's this range between 480, that point, to 520. This is what is called the expected move, which is a one standard deviation theoretical move. And one standard deviation in statistics is a 68.2% probability. So what this does for you, and even if you'd never trade an option or never want to trade an option, if you use just this simple option platform tool, you can kind of project where prices are going to go based on all the option volume. Option volume is much more than just usually the regular volumes of the market. So in this example, it's telling you that the normal move for Google for 10 days will be up to 520 to the top end, or down to 480 to the bottom end. And this move from these 2 points, that's one standard deviation. So the probability is it's going to trade in here 69% of the time. It's going to trade between these two numbers. Now, as you go outside that, the probability of making money goes down, down, down. So here, like at 2.1% on that tail, let's say the options are, you've got a 580 strike Google call. It might be 5 cents or $5. And you're thinking, wow, that's cheap. But when you look at the statistics, the probability of it getting there, it's so low. That's why the price is so cheap. You're taking a lot of risk, so you better be rewarded. So that's how it works. And if you understand that concept, then you understand, okay, that's why you can sell options sometimes, and it really helps you. So remember, trading is a business of probabilities, and to be successful as a trader, you really need to focus on controlling your risk, and one important step is to know the winning probabilities of any trade you're going into. And a simple and free tool for doing this is also the option delta. That's one of the option Greeks. And it's one of the best ones to use. You can use it, the option delta. That's one of the option Greeks. And it's one of the best ones to use. You can use it for a couple different things. First off, it's going to tell you the value of the option based on the underlying itself, how much it moves. But the other way I like to use it is it helps you, gives you a measurement of probability of price movement on the underlying itself. And it's what I call it kind of the back of the envelope measure of probability. So it's real easy and fast to do. So again, in this bell curve, you'll see the example. If you look on your option chain and you see an option delta of 68 or 70, that can also tell you that equates to the strike that you're looking at having a 68 or 70% probability that it will be in the money by expiration. Now, if you also look down further out and you see an option delta of, say, 16 or 5 or whatever, but in this example, plus or minus 16, that's equivalent to those outside one standard deviation points here. And the 16 delta then is telling you that that's got a 16% probability of being in the money. So you can see as you go further out, those deltas will get smaller and smaller, and that also represents the probability of price being at that particular spot by expiration. So here's an example to illustrate it, just totally theoretical for you. Here's Google, and this is the option chain, option analyzer on Thinkorswim, TOS. And this is a free platform, so you can use this. So here's Google, and here's all your information. Here's the at the money price, 682.45. This is days to expiration, given to you there, 22. The expected move here, plus or minus 34. So if you look at this and then input this into the actual pricing model, this is called price slices. You can set this to one standard deviation here or minus one here, and this gives you the exact theoretical probability, one up, one down on standard deviation. So you'll see it's 622 to the upside, 542 to the downside. Now, a quicker way to do this, and this is the way I like to do it, is just come to your strike price right here, come all the way down, and see, find that 620 right there. So the 620 equivalent strike right there. Go over here, and what do you see? 18 delta. So that's very close to that 16 delta that I showed you in the prior distribution curve. So what you can do is then, as a trader, you can say, okay, and you're looking at Google, you're long, you want to go long, it's 582, and you're thinking, yeah, I wonder, 620, if I look, those things are going for 5 cents. Maybe I should buy those, 620 calls or something. But then you think, wow, they're cheap. I wonder why. So you go over here and you can see the option delta says, well, you've only got an 18% probability that it'll be at this strike by expiration, based on where it is now. So it's a really great quick tool to help you assess risk on any trade you're taking. So by using this probability analysis, it provides the trader a very useful tool to determine your price targets that you can trade against, and it's also great for setting your hedges, so you know where to set hedges. So based again on probability, you can see that approximately 68.2% of options bought will expire worthless, and based on this, it's a good idea for all traders or investors to also consider selling options as well as just buying. So I do both, but I always look at the sell side as well. Now, it's this added option strategy for profit or hedging. It will make a dramatic and positive difference in your trading performance when you understand it and start using it correctly. Now, this is why, again, professional money takes advantage of selling options for profit generation and risk management. Now, step 5 then is selecting the right, income option strategy. And again, the goal for every trader should be to select trades that are based on what's going to provide you the most consistent positive return and not always that greatest return. So you want to be consistent as a trader. That's going to help you to grow your account. And you don't want to have a lot of big equity curves up and down. So you want a smooth kind of equity curve. And one of the best ways to achieve this is by knowing the income option strategies that are available, and then select the one that's best for your trading style. So everybody here today is going to be different as far as the amount of capital that you have, the amount of risk that you're willing to take, when you can trade, when you're available to trade, etc. So you're going to have to pick the strategy that best suits your lifestyle. And so one thing to do is then look at the various strategies that are available and see if they kind of match what you need. So the basic income strategies that are out there, you'll have the covered calls, calendar spreads, diagonal spreads, long iron condors, and credit spreads. So these are all good type of income option strategies. Now, some are better than others in certain situations. You know, if you're in a good, strong, consistently moving bull market to the upside, these covered calls can be a great way to trade. If the market rolls over and is real volatile, you're going to get turned upside down. So it might not be the best. So you need to know what conditions to use these particular strategies in. And for me, the best or my favorite income option strategy comes down to the credit spread for 4 reasons. One, it can work regardless of any market direction. So it doesn't matter about the market. You can use credit spreads any kind of market. 2, it can almost always work even if you're wrong, which is pretty cool. And 3, the probability of profit, if you just go into the trade out of the money at 1 standard deviation, as soon as you put the trade on, you've got about a 68% chance that that'll be a successful trade, even without using technical analysis. So just think then, if you have a good system, which increases your profit, that's going to increase your probability even more. And then 4, this is the best way to hedge core positions by using options against it by selling. So there are 3 types of credit spreads. You've got the bear call credit spread, bull put credit spread, and the long iron condor. And first one is the bear call credit spread. It's best to use if you think the market's going to go down. So you can either sell premium naked without a spread, which is fine if you've got portfolio margin account, or if you're not worried about unlimited risk, or if you want to protect yourself and hedge yourself, then you do it as a spread so that it's going to minimize any potential risk. And what you're doing is basically selling a call with a lower strike while simultaneously buying another call with a higher strike in the same month. So it's a protected premium collection strategy. So here's an example of a bear call credit spread. So this is on the SPX, the S&P 500 cash, and it's trading down here in this example about 1988. So you're thinking that the market's going to go sideways. It could even go up some, but not going to scream up or go down. This strategy allows you to sell way out of the money. Up here, sell the 2045 call, and then above it, as your protection, you're buying the 2050 call. So it's a $5 wide spread, 2050 minus 2045. That's $5 wide. So that's equivalent to $500. Now, in this strategy, you're collecting a credit of $100. So that goes straight to your bank account, and that reduces your at risk to $400. So if you did nothing at all, and this went straight up, the max you would lose is 400, and that's your capital at risk, and that's also what you put up as margin. So all you would have to put up on this trade is $400. So if you did nothing at all to manage this trade, that's the most you could lose, 400. And if it works out, it just stays down here. I call this a lot open prairie. You keep that 100, that's a 25% return on your capital at risk, which is a nice return. So that's the bear call credit spread. Then the second type is the bull put credit spread. And this is a strategy you want to use if you think the market's going to go up. It's a bullish strategy. You're basically selling one put while simultaneously buying another put with a lower strike. So you could do this just by outright selling puts naked, which is a bullish strategy, but you've got unlimited risk. This one caps your risk. Now here's the example to show you how this works. This is on WIN, and it's trading right here at $207. Now you're real bullish on it. You think it's going to just go to the roof. So you could either buy the calls outright. You could buy the stock at 207. You get call debit spreads. You think it's going to go up, so it goes up, but then it just turns right back around. We've seen that a lot, right? So with this strategy, it's a less risk that you're taking on because you're selling it out of the money down here. So you can see in this strategy, it's bullish. You're selling the 187 puts way down here. You're buying the 182 below it right there. So again, this is a $500 wide spread. So you got a $500 wide spread. You collected $130 credit by doing the spread. So you've got that. So your at risk is $370. So that's what your margin you put up. That's all that you could possibly lose if it goes down here. Now, there are a lot of defensive strategies that I teach, but this is if you did nothing at all, you'd lose 370. As long as it stays above that red line, you keep the 130 credit that's in your bank account, and that's a 35% return on your capital at risk. And so these are low capital required type strategies as well. Now, the third one is your long iron condor, known for being a kind of a non-directional low risk strategy. And all the long condor is you're combining that bull put credit spread with the bear call credit spread together. So you have two spreads put on at the same time. And with this, you can actually leg it, but here it is. You'd have your two spreads. You'd have your bear call credit spread here and your bull put credit spread here. So if it comes up there, you could set this spread. If it comes down here, set it. You can leg that. But these are for certain markets where they're sideways, and I don't do these as much because we'll see those markets go sideways, then all of a sudden they go straight down. But it's a strategy where you can get that double premium. Yeah, so you want to place usually do these type of setups where you're one standard deviation or more out of the money if you can make the premium work. Now this is really key here. So this will really show you how this can the risk reward of these type of options can help you. So what we're going to do here is compare the risk to the reward of two long option strategies. So we're going to look at the first strategy, your typical, okay, let's go long options, because the market's going to go up. So you go out there and you buy directional calls. So it's a bullish strategy, very bullish. Second one though, you're still bullish, but no, we're going to be a little bit more cautious and conservative with our risks. So we're going to sell an out of the money bull put credit spread, both bullish strategies. So here's the first strategy. So this, we're going to say Charlie, he's very bullish on win. So he's going to look at buying the $207 calls, and they're at the money, and they're going for $11.40, which is $1,140 per option contract. So it's a defined risk trade. The most that Charlie would lose would be $1,140, but he can make unlimited profit to the upside. So it's got infinite return, fixed amount of cost or capital at risk. But $1,140 might be also expensive for some traders, right? So that's just for one contract. Now the other strategy is strategy 2. It's also bullish, but this is selling the 187 put below it, buying the 182 out of the money bull put credit spread. The spread was being sold below Win's prior low of 189, and it was also being sold at 9.5% below where Win was trading at the money when it was put on at 207. So again, two strategies, both bullish. One's a different amount of risk. So Charlie's doing this one, Susan's doing strategy 2. So let's see how it turns out. So strategy 1, Charlie comes in, things are looking good. He bought that option. Man, it's going through the roof. But then all of a sudden the market collapses on him, and he looks at his P&L on May the 8th right here, and all of a sudden Win went from 207. It was way up here, and then all of a sudden it's at 196. He opens up his P&L, and he's down $583 just for one contract. So that's smarts, So that, I mean, he was going for the home run, but it was looking good there for a while, but then rolled over. Now on May the 21st, the market finally comes back up a little bit, and it's at 205. Charlie opens up his P&L. He's still down $518 per contract, so not much better result for him. Now, Susan, she was bullish, but she wanted to be more consistent and conservative with her approach, so she did strategy 2, and she consistent and conservative with her approach, so she did strategy 2, and she sold this bull put credit spread way down here. Win was trading right there, and she sold this bull put credit spread there, the 187, 182. Now she was protected for any big move down. Maximum she could lose is 370, makes 130. Now let's see what happens to this trade when the market rolls over. So the market rolls over, and it goes, it was at 207, went up, then crashes down. So Susan opens up her P&L. Well, she's down only 38.50. Charlie's down 583. So she's she's okay with that. She can weather the storm. Now on the 21st, she comes in and she looks at it, and she can look, it's gone up a little bit, so she opens up her P&L straight at 205. Well, she's in the green. She's up 78.50, but Charlie's still down 518. So this demonstrates the difference between risk and reward for two bullish strategies. So I call this the most forgiving trading strategy ever, the credit spread. And here's another example. Now, I like to use these on the S&P SPX or NDX or RUT, the indexes. So I like to use it directionally as well. So this is an example here, selling the S&P 500 SPX index option, the bear call credit spread. So it was trading right here at 2103, and when it was trading there, sold it just about one standard deviation, not quite one standard deviation out of the money. Sold the 2140, you can see here, bought the 2145. So that's the spread up there, but you can see it's above where the market was trading. So the way I like to place these is, okay, is when the market's moved up, and then when it's starting to top, and I spot that top with momentum, my momentum indicators, then I sell a bear call credit spread. So by doing this, it's a good, easy way, low stress way to collect premium. And even if the market goes sideways and doesn't go straight down, which we've seen so many times in this year, we saw the market go sideways for 6 months. This has been a great strategy. And so the max capital at risk would be $400. You received on this trade, you received it was a $500 wide spread. You received $100 credit. Okay, so then that puts your at risk 400. So that's your margin you put up. This was right about one standard, a little bit below one standard deviation out of the money. Now your return on capital at risk would be 100 divided by 400, so 25%, as long as it stays below that level. And this was put on the 4th of November, taken off 9 days later, the 13th, and kept that full credit of 25%. So if you do one contract, it's 100. If you did 10, it's 1,000. And that's your capital at risk. And that's your, basically you've got about a 68% probability without any directional indicators of this being a successful trade. Now with me, I also added my indicators, so it increased my probability of that being a winning trade. Whoops. So that's how I'd love to use it. So here's what it looks like on your analytics when you chart that out. So this was selling that 2140, call short right here, buying the 2145. Here is your protection. Received $1 credit. Now it went down here, on the 13th, the market fell down to 2030 and took it off at max profit, was expiring, and that's, $100 per one contract or 1,000 for 10. Now, the other way to do it is in the money bull put credit spreads, and this is just another example to show you. So here's this is also a directional trade setup, and this is on Netflix back in mid-November. It was trading at 114.50, and so this was a directional trade as well. You could have just bought Netflix, the stock, or the options, but I like to do these when I can get 1-to-1 or better. So Netflix was trading right about here, and at 114.50. So sold the bull put credit spread, the 114 bull put credit spread, for a little bit better than 1-to-1 risk reward. I'll show you how this worked out. So it was $1 wide spread. That's the other thing with so many different options. Now you've got dollar wide spreads, you've got 50-cent wide spreads, so you can do a lot of these trades with very narrow spreads, which also equates to very low risk. So on this trade, it was 50 cents in the money, so collected $51 credit. So it's $1 wide spread, $100, minus the credit received, 51. So that puts your at risk $49, and that's your margin. So you can see that these can be very small capital type requirements needed to trade these. So this is $49 you put up. It's basically a little bit better than a one-to-one credit, a one-to-one risk reward. And so as long as the price closes above the short strike of 115, you keep the full credit. Now, it has time value decay, so you can get out before that in most situations. And here's what it looks like when you chart this out. So here's your 115 short strike, your 114 there, dollar-wide spread, $51 credit, and took it off because it closed above the 115. Just took it off at a nickel. It went down, bought it back in, so made 46 cents per contract. So I usually will take them off before, if you get that time decay in there, and you can buy it back for 70-80% of your credit. Now this is the other way to use selling options, and it's for defensive hedging, and I call it offense defense trade setup. And this is an example on Lulu. So there was a core position being long a call debit spread on Lulu, and the market started to turn over, stall out. This was back in August when the markets were jittery, and then they did finally crash. So this is going to show you how you can use this particular strategy for hedging. So here was coming into the trade. Lululemon was this is kind of what we call a volatility squeeze, real tight price pattern, and price is going to either break hard to the upside or break to the downside. So I like these type trade setups, and using my indicators, the momentum was up, so I was looking for a break to the upside, so bought Lululemon right here using a call debit spread. So I like to buy options as well, so did a call debit spread, looked good, it went up, but then it started to turn over. The market at that time, there was a lot of stuff going on back in August, you can see, and then the market did turn over. So rather than get out of Lululemon, I hedged it, looking to see if it would bounce back up, because we had earnings coming up, and part of the thing I thought it would probably trend into earnings, but this is when the market hit hard to the downside in August. So let me show you what I did here. So here's the step you through this kind of progression. So Lululemon, the original trade setup was on the 17th, so bought the 65, 67.5 long call debit spread, paid $120. Okay, so defined risk trade, that's all I could lose if I was wrong, and that was a call vertical debit spread. Now, market started to roll over, so instead of just getting rid of the trade, I hedged it on the 20th by selling it out of the money, 72.5, 75 bear call credit spread. It was going at 38 cents. So the 72.5, 75 bear call credit spread. Now, I did it instead of just, you could have done it 1-to-1, but I wanted to be more aggressive on the hedge, so I sold it 2-to-1. So I sold 2 of the credit spreads for each one long call debit spread. So what this did was, by selling 2, I increased the credit that I brought in to $76 versus 38. Now, this credit then reduces my net downside risk from $120 less the credit I received. So now my downside, if the market kept going straight down, now my downside risk is adjusted just to $44 per contract on that original option position. Now Lululemon got caught up with the rest of the market, dropped 13%. That original debit spread then was in the hole $80 per option contract, but I had reduced the risk because of the credit. Now the next day, the market just got way oversold, bought back that credit spread that was at 76 cents, bought it back at 18. So 76 minus 18 was $58 per option contract. And so that adjusted that trade from 120 minus the 15 received in on the adjustment to $62. And Lululemon went back up on the 3rd and went to 128. So, sold that off. If I'd waited just, if I'd stayed in the position, I would have had a drawdown to $80, and I would only made, 8 cents if I held through the whole thing and held my breath. But by making the adjustment, it reduced my cost down to 62, and that made a $66 per contract profit, or 106 return on capital. So that's the way you can use it to adjust what you're doing. And here's what it, it's just basically you said it basically created an iron condor, kind of an unbalanced iron condor. So just, different ways that you can use these to benefit your trading. So it's additional layer for your trading, additional tool for you to use. And I wanted to kind of share that with everybody here today to show you some other things that you can do in the markets. So got a lot of questions here. Now, next thing I want to show you, just since probably a lot of you here don't know me, I'd like to share just a few comments from some of my members and clients, just to kind of show you what I try to offer everybody that I work with. Seeing a lot of good questions here, so just bear with me. See a lot of questions on earnings, so I'll get to that. That's some really great questions about doing these type of trades through an earnings release. So I wanted just to share that. It's very rewarding for me or anybody that teaches to have a positive impact on somebody's trading. So just kind of wanted to share that with everybody. Now, here are some things that I want to talk to you about here, and then get into your questions about how you can start using this type of trading to generate a more steady stream of income for yourself each and every month. Now, this is a special Traders Day, National Traders Day, so I put together a very special bonus package here for the first 30 that sign up, and it's a very special package here. So you're going to get, first off, my course that I did 100% on credit spreads. It's a 5-hour on-demand course on credit spreads. You'll get that. It's broken down in 30-minute modules for easier viewing. You'll get the 183-page PowerPoint. My courses are very detailed. This also comes with a 13-option strategy diagram, but you're also going to get a bunch of other really good bonuses, which I'll show you. And it's a very cheap entry, 97 bucks. So if you've never traded an option and you want to explore looking at options, this is a way to take advantage of it. So just paracycletrading.com/up, all small cap. Just put that in a browser, pop it up, and you'll see this pop up at $97. You'll say credit spread income course. Now, you won't see all the bonuses. So the first 30 that sign up, you'll get, let me show you what additional you'll get. Now, the other thing too is you'll get a money back guarantee. So if you do decide it's not something for you, just send us an email and we'll also send back your 97. So it's a total win-win situation if you're interested in exploring this trading, or if you've already traded credit spreads and you want to get more proficient at it. So course 1, you get trading credit spreads for income. Again, it's a 5-hour course, recorded 30-minute modules, 183-page training manual. Now, this is, if you decide later you want to buy it, it's on my website, Paracycle Trading, $1. I keep saying $1.97, $197. Now, I'm also going to throw in, this is awesome too, is butterflies. So these are additionally kind of like credit spreads. So I'm going to also, for today only, this special, I'm going to also throw in this course, High Reward, Low Risk Option Butterfly course. This was a course I did a couple months ago. It's a 4-hour course, recorded 30-minute modules, and it's on the amazing option butterfly spread. It's a 119-page PowerPoint you get with it, training manual, also on my site, 197. So you're going to get all this, plus we're going to do a follow-up live coaching session. Once you've gone through this course, this will be in a couple of weeks. Give yourself some time to go through everything. Once you've gone through this course, this will be in a couple of weeks. Give yourself some time to go through everything. And this is, I'll send out an email on that, so you'll get access to that. And the other thing I'm going to throw in today is 1-month trial to my Paracycle Trading Club, which is $97 a month. But you'll get all that today for just $97. This will be a 1-month trial. you decide you want to stay, then it's $97 a month. So it's a super good National Traders Day bonus package for anybody here that's interested, and I'd like to make that available to you here. So here's the link one more time. Hopefully everybody should be able to see that, right? powercycletrading.com/up. And again, if it doesn't work for you, send us an email, support@powercycletrading. You'll see the email address, and we'll send you your 97 back. It's win-win. Now, in the course itself, what we'll go through in the course is how to use credit spreads for creating those low risk, high probability. These are high probability trade setups, and then how to use the credit spreads. I like to use them on these index options, SPX, NDX, and then how and when to use the deep in the money. So when you do a deep in the money, you can reverse your risk reward to a positive risk ratio versus negative. So teach that in the course. Now also how to steadily and consistently grow a small account. So you can see that some of these things can be done for as little as $30, $40 at risk. So you can consistently start making these things and growing your account using these credit spreads. And then the big thing that I couldn't cover here today was, okay, well, what happens when a trade goes wrong? I mean, we never get every trade right. That'd be pretty nice. But I show you and teach you 6 defensive strategies for these credit spreads. So if something does happen, there are 6 different strategies based on certain market conditions where you can use these. So this is really well worth the course just right there. A lot of people are intrigued and will use credit spreads, but they don't know what to do when things go bad. So that's a big part of it. And then how and when to use the iron condor. It's not one I use that much, but I'll teach you when to use it. Position sizing. This is another great thing. If you're trading a lot and you want to, diversify your risk and reduce your risk, and I'd show you in this course how to add credit spreads to reduce your risk by position sizing. Use credit spreads along with the other strategies you're using. And then again, how to take that higher probability winning trade that you go into and increase it to 90% probability, which is so cool about using credit spreads. And then a step-by-step guide to execute the spreads, some technical analysis tools that I like to use, best market time frames for the spreads. Do you go out a week, 10 days, 15, 20? How do you look at that? When to do it? And then how to do these trades into the day so you don't have to stare at your screen all day. So it's a 5-hour course, and then also throwing in that butterfly course, and this will go through the Greeks, theta decay and its impact on the butterfly spread, volatility, implied volatility, its impact on the butterfly. Now pricing the butterfly, the effects of that time and volatility on it, and then the basic foundation. What is that butterfly? What makes it such a cool spread? And then how to use this butterfly spread for monthly option expiration. The butterfly defense, which is a vertical defense that we can use on any kind of vertical debit spread. The broken wing butterfly, which is just a really interesting, neat trade setup where you can get very little capital to go into a trade. And then the iron butterfly, which is selling volatility. You can literally take a capital of $10 and turn it into 190 with the butterfly. So throwing that in as an additional. And then my trading room. This is everything you'll get with this free trial for this 30 days if you like. The virtual trading room I have open every day from 9:10 a.m. to 4:15 Eastern. I do a daily market update videos for anything that I'm looking at during the day, swing trades, day trades. I show you all that, go through it, do nightly video alerts on that videos of any potential breakout trades I'm seeing or seasonality. I do a lot of seasonality type trade work. And then we do a weekly Q&A. Every week I do a live 1.5 hour Q&A where you can come in and ask any trading questions. We go through a lot of trade setups, things like that. $20 credit each month you're in the program, discounts on everything that I do. So going to also throw that in for National Trading Day. So everything and a zero back, money back guarantee. So hopefully you'll have interest to take advantage of this, and hopefully I'll get to work with you guys and gals in the future. So let's get some of your questions here. Okay, so questions here. Let me enlarge this so I can see. Let me scroll up. So Um, so you can do these on the Dow as well. You can do this with ETFs, DJI. You can do it with the SPX, the various ETFs. And the question, do I prefer credit spreads or debit spreads? I like both, but I will always look to see if there's a good credit spread opportunity. But I also look at the implied volatility. If it's high implied volatility, then sometimes you can get some fantastic premiums to work with you. But the other great thing about credit spreads, I like to do maybe at times combination of both to reduce my risk. So I might be doing a long debit spreads, maybe call debit spreads, and then I might, if I'm like, say if I'm bullish something, I think it's got a good potential trend to the upside. Well, instead of putting everything on one particular trade strategy, I will diversify and I'll do, maybe I'll buy out the money calls or in the money calls, call debit spreads, and then I'll also do out of the money or at the money maybe bull put credit spreads because the risk uh, diversification that you get to it. So let's say you had $1,000 to put on one trade, rather than doing it all on just buying $1,000 worth of calls. If you're bullish, diversify that by doing X number of dollars for long calls, maybe X number of dollars for call spreads, and then a big part of that also for credit spreads because it reduces your risk based on the probabilities. So that's a really great way to utilize the credit spread along with the other things you're doing. And the price, once you're a member, it's $97 a month. So at the end of the 30-day trial, it'll be $97 for each month. And again, you can cancel it at any time. The risk will depend on in the money, out of the money. There's variations to the risk, but in the course, it pretty much outlines and teaches you all that. I'm backing up here to look at some of these other questions. When you get out of a bull put credit spread before expiration, so you don't have it close in the middle of strike. So yeah, if you're in a bull put credit spread or a bear call credit spread and the short leg is in the money, you want to close it out before expiration. Otherwise, you could be assigned. But if it closes, if it's not in the money and out of the money, you just keep the credit, it goes to zero, and that's yours. Let's see, trying to look at the other questions here. Yeah, infinity. Yeah, it doesn't infinity or beyond. Yeah, well, it's just a common way to express that there's a lot of risk. So infinite risk. So it could go to zero, you lose your whole investment. So that's one way to look at it. It just clarifies that there's a lot of risk. So if you're selling naked options, I mean, it's got a lot more risk than if you're selling a credit spread, which has a limited amount of risk. In earnings, okay, so when you're trading earnings, I teach an earnings course, and the way to trade earnings is to have three separate type of trade setups. You'll have one trade where it'll be a pre-earnings trade where it may be a trend into earnings, so that's one specific trade, but you want to be out of that trade before the earnings are released, the day the earnings are released. So that's one type of trade. It can benefit from the improvement, increase in implied volatility. So you want to be long options going into an earnings. Then on the day of an earnings release, you want to usually sell options to collect premium, or sometimes you actually want to buy. And it just depends on what that stock's history has been on an earnings move. Now, my way I trade earnings, probably a little different from other people, is instead of selling volatility for the volatility crush, which happens after an earnings release, most of the trades I do is I'm actually buying options, a condor or something, to take advantage of greater than the expected move, either up or down. So greater than a one standard deviation move up or down. So I teach a course on that. That's a very, very great, cool strategy to do. And these things, the way I structure, it's all about the stock. They're high probability winning trades during earnings. So that's one. And then you have the third trade is post earnings trend after an earnings. So you got to separate it, to that kind of trade setups. So hopefully that answers your question on selling into an earnings release. No, you're not going to get, Edwin, you're not going to get double charged there. So just, any questions, support at Power Cycle Trading if you have any questions there. Yeah, like Ulta on Thursday. Yeah, exactly. Um, so I'm back, trying to go back up here. Hopefully this scrolls down so you can't really see all the questions at times. So it's powercycletrading.com/up. And I tell you what, I've got 30 have already come in here. So I'm actually over 30, but since this is National Traders Day, I'll just keep this offer open for the rest of the day. If you guys are interested, just use that link there, powercycletrading.com/up. It'll be open for the rest of the day. And I'll honor all these bonuses that I showed you. This is a great question. What is the hardest part of option trading for you? The hardest part of trading in general is just being patient and just following your trading rules, your risk management rules. So for every trade that you put on, when you put that trade on, have a trading plan for that specific trade. Just don't be, seat of your pants trader. Like one moment you think, wow, this market's strong, I'm just going to buy something. Don't trade from emotions. Be very, very analytic about what you're doing. Be almost mechanical and robotic. So detach yourself from the emotions. So when you put a trade on, have a plan for that trade. So when I do an option trade, let's say I buy a call debit spread. What I'll do is I'll define my risk using Fibonacci and using the expected move, like I just taught you, that expected move. Now, if the trade doesn't go according to what I was originally thinking it would do, then I have a defense that I'll put on, a hedge that I can add to it. I might convert it to a butterfly. I might convert it to an unbalanced butterfly. There are a lot of different things you can do. So in these courses, you'll get a taste of all that. So plan your trade, trade your plan. That's exactly right, Tina. But always have a plan, and then the thing is too, is that everybody here, everybody that's presenting today, everybody that's teaching you things, we're all still learning too. There's no perfect trader. There's no perfect system. Trading is just a journey of learning. So I learn something each and every day. There's nobody that masters trading. So there's no such thing. So just learn from other people, learn from their mistakes. So a lot of stuff that I teach are because of the mistakes I've made. So I can, the mistakes are the ones that stay with you. You think about those. So I try to improve off the things I've done wrong. No. So Scott, any questions on that? Just send an email to support at Power Cycle Trading we'll just clarify any of these questions that you have. Yeah. So the question is, do you teach how to trade repair? Yeah. So this course, again, a big chunk of it is to teach you repair strategies. So there's 6 strategies that I teach on how to make repairs on credit spreads. So when you're doing a credit spread, a big part of it, if you look at the statistics on a credit spread, so if you're having a negative risk ratio, so let's say, let me just back up here a second here. So if you've got, so a couple of these examples, you would see that you make your potential profit is 130, but you're risking 370, right? So that's a negative risk reward. So you could do, a bunch of trades and make every time, then you can maybe do one where you lose and you give back your profit. So that's certainly possible. It happens to a lot of people too, probably. But the point is, when you go into this trade, the first thing, just for this example, we'll say, is when you go in and you're out of the money, as soon as you put the trade on, without having any idea of market direction, that credit spread would be at 68.2% theoretical chance of winning without knowing anything else. Now, two, to help you improve that probability even more, is if you have a decent way to trade, if you have a system, or a methodology, and you feel that that's better, this is if you're 50-50. So when you trade one, if you go in and you're 68.2% probability without knowing anything else, that's a 50-50 probability too, right? So knowing nothing else, I go into that trade, 68.2. But what if you had a trading system that was made 60%, winners versus 50-50? It was, 60% winners versus losers. Or what if you had a system that was 70% versus your losers? So what would that do? So that increases you from 50 to 60, so add that to it. So you just increased your basis from 68% probability of winning to 78% probability of winning. See that that's what's really exciting about this. So if you did nothing, you have a 68.2. If you add some technology, some trend, some directional stuff to it, you can increase your probability. Then three is defending the trade, defense. So you don't want to ever lose your full at risk. So if it was 370 you have at risk, never lose the full at risk. So if it was 370 you have at risk, never lose the full amount. Maybe you can cut it to only losing 50. Maybe you can cut it to only losing 25%. So it's a kind of a program of a campaign. So you can create the structures where you can just do 1, 2, 3, so you'll improve your trading probabilities. So that's how you have to look at it. A lot of people say, oh, bullshit, excuse my language. You do credit spreads, you could do, you do 10 credit spreads, you could have one loser wipe you totally out. Theoretically, statistically, absolutely yes. But what they don't take in consideration is point 2, improving your probability by directional trend trading. 3, defending the trade. If you did nothing, just sit there all day long like a frog on a log, you're not going to do any good regardless of what you do. And question, why not strangle the play and cut the losers? Yeah, you could add strangles. There are all kinds of different things you can do defensively, but I like to keep it simple. So I teach you some real quick, simple ways where you don't have to think too much. So there's a couple one specific strategy I teach you in the course that will be worth the course itself, and that's how to defend any kind of vertical. It can be a debit spread or it can be a vertical credit spread, and there's a strategy to automatically cut the at risk down quickly. Then it gives you time to sit back and think about what you're doing. Because in the markets, you look at Thursday. If you panicked out Thursday, then look what happened Friday. So there are ways that you can hedge yourself real quick where it doesn't screw your whole position up. So that's the key, and that's what I try to teach, and that's what I try to do myself. So it's good stuff. But the thing I love about trading too, it's such a mental game. You're always constantly having to think, and I like that. I like that a lot. So I hope I got all the questions here. Is there anything else I missed? Because this scrolls up, so I may have missed a question or two, but I'd be happy to answer it. Okay, well, great. All right, thanks, everyone. Enjoy the rest of your day. This is only good. This is good through the rest of the end of the day, So here's the link. Yeah, I'll leave it open till the end of the day. But it's a win-win, like I said. So, you've got the money-back guarantee of getting 2 courses plus trial membership and a lot of good stuff, plus an extra follow-up Q&A. So when you come in, you can go through the course, then come in and ask questions. And if you can't make the Q&A, you can send in the questions by email, and then I'll answer it, and then the Q&A is recorded, so you can go back and look at it. The course you'll have for as long as you want. This is all put on the cloud, so you'll have a login ID specifically for you for this course, and it'll have all this stuff in there for you. So, if you come back a year from now, and if you don't have your ID or login, you forget it, you just send us an email, and we'll have all that stuff, and then we'll just reissue a new login ID, and then you can access it from wherever you are. Okie dokie. All right. Well, thanks again, everybody. Enjoy the rest of your day, and thanks so much for having me here today to be a part of this National Traders Day. It's fun. Thank you very much, Sam. Thanks, Song.
All right, thank you, Larry Gaines from Paracycle Trading. Wonderful presentation as always, Larry. Definitely hit the nail on the head at the end right there. Listen, guys, I appreciate you guys, everyone in here coming out to this, Trader Spectacular here for National Traders Day. Just want to give a quick thanks to all of our presenters today: Price Headley from Big Trends, Andrew Keene from Alpha Shark, Mish Schneider from Market Gauge, and of course, Larry Gaines from Paracycle Trading, and above and beyond, of course, Fausto Puglisi here with Cyber Trading University. Listen, guys, if you have any questions at all, definitely send us over an email. I'll put the support email in here right now. Any questions at all, definitely send an email on over right over there. Mr. Laughlin, when and how will the video presentations be available? I missed Price and part of Fausto's sessions. No problem at all, Mr. Laughlin. Listen, we're going to get these recordings sent out to you, I believe, by Monday, the absolute latest. So we'll have those sent out to you on Monday, just a matter of converting the videos and everything else. So those will be sent out to you immediately. And as far as everyone else here, guys, listen. Education is prime. It's so important in terms of learning how to trade and becoming a successful trader out here. All of our presenters today really hit the nail on the head. Listen, it's a 95% failure ratio if you do this by yourself. Whether it's with Cyber Trading University, Big Trends, Alpha Shark, Market Gauge, or Power Cycle, go get educated. Guys, go take some courses. Go get educated on the market. You can't do this by yourselves, all right? So, on behalf of everyone here, my name is Josh Levitan, one of the C2 instructors over here. I wish you guys a great weekend and happy trading, guys. Take care.